What I'd like to do in the following 1 hour is essentially to show that repeated interventions by governments into the free economy, into the free market, into the capitalistic system, and interventions with fiscal and monetary measures and policies have actually led to more uncertainty, higher economic volatility. In other words, the business cycle has been either longer and has ended with booms and then busts followed, and also that these monetary policies have led to more financial instability. In other words, the markets shoot up, go into a mania and bubble stage, and then they crash, and that this has actually had a very undesirable impact on the majority of people. Very few people have benefited from these monetary policies. Basically, in the following, I shall analyze the impact and the unintended consequences of fiscal and monetary policies on asset prices. Asset prices can be real estate, commodities, art prices, stocks, bonds, and so forth, on interest income, on credit growth and government debt, on corporate profits, and in particular on income and wealth inequality, because as you probably have been reading over the last few years, there is an increasing number of people that have or that are economically suffering, and at the same time you have an increasing but small number of people that have become incredibly rich. When I started to work on Wall Street in 1970, there were maybe 1 or 2 billionaires in the world. Today we have more than 2,000 billionaires. So there has been a concentration of wealth, and I shall show how essentially money printing benefits very few people at the expense of the majority. You can see here, this is Chinese commodity consumption as a percent of the world's consumption. So in the 70s it was like 2% in the case of metals, and then up to here 90 we were still at 5%. Then around 2000 we were at 12%. So okay, in year 2000 China takes up 12% of total world's commodity consumption for metals. Now 47%. In other words, the metals consumption of China today is roughly half of the world's metal consumption. For copper, lead, and so forth. For agricultural, it's a little bit lower. For oil, it is only, I think, 12% at the present time. But it will go up. But it's up from, say, 1% here to now 12%. But for metals, we've gone in 12 years from 12% of world's consumption to 47%. This is an incredible growth, incredible shift in the balance of economic influence and the power. Now the question is, will this continue? Obviously, China will not consume all the metals in the world. There is a limit to growth, and I think the limit may have been reached for several reasons. In the early stages of industrialization, say Japan after the 50s, South Korea 60s, 70s, 80s, China after 1990, the demand for commodities goes up a lot because industries are being built and so forth. But once a country is industrialized, like the US, commodity consumption is flat to down. The US economy has no impact on the world per se, because 70% of the economy is consumption, and of that 70% are services. They don't require commodities. So whether the US grows at 2% or contracts at 2%, has zero impact on the world. But whether China grows at 8% or only 4% or 0%, that has a huge impact on the world. Because if China grows only at, say, 4%, then commodity prices will have the tendency to go down, and the income of the commodity producers will be hurt, and then they will buy less from China, and they will buy less from Korea. And so the Chinese growth is boosting the economic growth rates through the rise in commodity prices in the emerging world. In terms, the emerging world then goes and buys goods from China. And if this upcycle comes to an end and it goes into a down cycle, the problems could be actually quite severe. So, in my view, the Chinese consumption of metals will level out, as occurred for oil in South Korea. You can see here, in the case of South Korea, oil consumption rose very rapidly until 93, and then it went flat. And that will happen in China, not yet for oil, but for metals. And the problem in China is this. In emerging economies, we have excessive debt growth because credit, as we shall see, consumer credit has gone up a lot. We have poverty, we have declining growth rates, we have interventions by foreign powers, lack of water, and so forth. And so we have plenty of problems everywhere, rising wealth and income inequality, and we have inflated asset markets everywhere. How do we invest in this environment? As you can see here, these are the interest rates on the Fed fund rate. We've been going down. We are at 0 here today. In other words, if you keep your money on deposit, you're going to lose out because we have negative real interest rates. So the Fed wants to essentially force people to do something, either spend it or speculate in something. It's a tricky part, and you have to time it well. My advice is, given this environment, and we don't know how the world will look like in 5 years' time, my advice is to have a diversified portfolio of assets. In other words, you own, say, 25% in real estate, 25% in stocks, 25% in bonds and cash, and 25% in gold. So these assets are not necessarily correlated. Sometimes stocks will go up, sometimes gold will go up, sometimes bonds will go up. But say this is a kind of what Ray Dalio of Bridgewater calls an all-weather portfolio. It's not going to give you maximum returns, but it will preserve wealth. And you can rebalance the portfolio from time to time. In other words, you may go up to 40% in stocks if stocks have been very weak, or you may go up to, say, 30% in gold if gold has been very weak. So you can essentially shift around, but the basic position is to be diversified. Money printing has helped asset prices, notably stocks. But as I mentioned, when you print money, you're not sure entirely what will go up the most. So whereas since 2012 US stocks have gone up, well, the bottom was here in 2009. But basically over the last 2 years, emerging stock markets have been going down. US has been going up, and as you know, the Japanese stock market performed poorly until essentially a year ago, and since then we had a huge rally. So the difficulty is to know whether the further money printing will boost US stocks. If you look around the world, you could make the case that emerging stock markets are now better value than the US. I mentioned earlier the impact of low interest rates on corporate profits. Here you have pre-tax profits